How to determine the perfect time to buy a home. I'm having more and more conversations with more and more people who are considering this and trying to figure out, do I buy? Do I wait? Is this the right time? Interest rates, prices, is the market going to crash? Are the rates going to go out of control? What's going to happen? Should I buy my home or not right now? Especially first-time home buyers who might be a little bit more cautious or concerned about the process because it's completely new. So what we're going to cover today is how you can determine, is this the right time to buy a home or not? There are normally two things that most people will discuss and consider when they're trying to determine whether they should buy a home. Two things that are universal. Obviously, there'll be some specific things in every person's life that they're figuring out, but the two things as far as timing and looking at the market that they're normally going to look at are interest rates and property values or home prices. Let's go through each of those two and maybe some sub-scenarios. So we'll start off first with interest rates. Buying when home mortgage interest rates are low is an obvious advantage because the cost of money is less. And obviously buying when home interest rates are high is not as advantageous, so most people prefer to buy when the interest rates are low. Now let's talk about low and high because we have to think about low and high are relative terms. We always have to compare something to something else. I'm 6'2", so when I meet a person who's 6 feet, that's not tall. I'm taller than them. My wife, however, who's not 6'2", when she meets someone who's 6 feet, they're tall. Not as tall as her husband, but it's all relative. You get the idea. So, interest rates, are they high or low right now? Let's figure that out. In my opinion, anything that is a single-digit rate is low or normal, and anything that is double-digit is high. And let me explain what I mean by that. In the summer of 2022, we had the lowest interest rates we've ever seen. And the challenge, of course, with that is the subsequent years, everybody's comparing interest rates to the lowest that we've seen in 50 years. So everything looks high. If it's 4% or 5% or 6%, that looks high when we had rates available in the 2s and 3s. But if we look at a broader perspective, a longer time frame, the average rate is about 7.5 over the last 50 years. Anything below 7.5 would be low or below average. Mathematically speaking, anything above 7.5 would be mathematically above average. And anything around 7.5 is average. Now, let's then break down a little bit more about the low and the high and the relative. If you have $500,000, you could go out and buy a $500,000 house. Or you could put that money elsewhere and finance the house. So let's say you decide to put that money in the stock market. Most financial planners, accountants, online blogs will tell you that you're going to get about 10% return on your money over an extended period of time in the stock market. Obviously, there are years when it's much higher than that, and years when it's lower than that. But generally, they say if you leave your money in there, you're going to get about a 10% return if you just put it in the S&P 500 as an example. So, okay, I could take that $500,000, put it in the S&P 500, and get a 10% return. Well, if I buy a house at even 8% or 9%, let's say 8% mortgage rate, and they're not at 8% when we're doing this video, but let's say they are. Well, if I'm borrowing at 8% and I'm earning at 10%, well, that seems to be a 2% gap. I'm actually better off earning that money. And of course, I'm not taking into account the fact that you can invest in the S&P 500 with pre-tax dollars and post-tax dollars, and there's certain write-offs you may or may not have as a homeowner. We're not trying to get into it. Just a general way of thinking that if I can get a 10% return on my money, then if I can borrow at less than 10%, that seems like a good thing. So anything less than 10%, I'll do it, 7, 8, 9%. And certainly if they're below 7.76 and below 7.5, those rates are below average, that's a good time to buy because the rates are favorable. So when the rates are below 10%, buy. Let's talk about when the rates are above 10%. Now don't get afraid. I'm not saying the rates are going to 10% and we're cut this video. The rates are not anywhere, they're not at 10%, but let's just go through the full thinking exercise. Understand that the interest rate on your home is temporary. You can always refinance it later. You're probably not going to have the house for the full 30 years. So when the interest rates are 10% or above 10%, let's say, no worries, you still should buy the house. And let me explain why, because we're considering interest rates. We have to remember that interest rates are temporary. The interest rate that you have on your mortgage and the mortgage that you have on your home are most likely not things that you're going to have for the full 30 years. Very, very rare is a person who gets a 30-year fixed mortgage, which is the most common term for a mortgage. It's very, very rare that a person actually pays for 360 months, which is 30 years, and just pays it off. That's very rare. When I began in the industry about 20 years ago, we were told that the average mortgage is held for 7 years. And with all the refinancing over the last few years, that number has dropped to about 5. So the average mortgage is about 5 years. Now, rates have gone up. So let's say that it goes back to 7 years, okay? Then you're not likely to even have this mortgage for more than 7, 8, 9, 10 years. So yes, the interest rates might be a little bit higher, but the rate is still not permanent. When rates drop one day, I don't know when, you can always redo that. And certainly if they say, well, what if they don't drop? Well, if you're waiting for them to drop and they don't drop, that means you're not going to buy a house ever, or for 10 years. We'll talk about that a little bit later, but that's not a good move either. The point I'm making is that interest rates are temporary. So don't be concerned that that rate is something that you're stuck with forever. That being said, if the rates are high, that's a reason actually to not wait. If you decide, okay, rates are a little bit too high, we're going to wait for them to drop, you don't know when the rates are going to drop. 2 years, 4 years, 6 years, 8 years, 10 years. So if you're waiting during that time, if home values are continuing to appreciate, are you really going to wait for a 1% better interest rate or a 0.5% better interest rate, but pay $100,000 more for that house? I'll give you an example, which is me. When my wife and I bought our first home in 1998, yes, it's a long time ago, we paid $160,000 for that house, and 5 years later, we sold it for $320,000. It had doubled in value in 5 years. If we had waited for the rates to get better over those last 5 years, or those 5 years, well, the house would have been out of reach because it went from 160 to 320. So even if the rate got a 1% better or 2% better, I would have still been paying so much more. So I would have been, and what we did is we bought the house, regardless of where the rates were at that time. The rates were not, they did go lower later, but we had a 5-year plan to be in that house for 5 years and move out. So it didn't matter what the rates were going to do 6, 10, 12 years later, we're going to do something else. So we couldn't wait because values were still appreciating. Now, the average person stays in a home for 13 years, according to Redfin, and 8 years, according to ATTOM, A-T-T-O-M data. So you're probably not even going to be in the house for 30 years. 8 years, 10 years, 12 years, 13, 15 years. So even the house itself can be temporary, because when you sell the house, the mortgage doesn't follow you. You sell the house, the mortgage is extinguished, it's paid off, and now you're going to be getting a new mortgage on a new situation, a new house, or whatever it might be. So again, you don't want to sit out of the market for years waiting for interest rates to do something that it may or may not do. So the real truth when it comes to interest rates is that when the rates are low, definitely buy a house. When the rates are close to average, still a good time to buy a house. And when the rates are high, you still want to buy a house. You just have to now maybe be a little bit smarter about it. Maybe you can afford less, but you're better off buying a house and affording less rather than renting for another 5, 6, 7, 10 years while we wait for some other external thing to change. It's going to be rare that everything's going to be just right. It's like trying to leave the house to go to the store or go to movies or work, and you're going to wait for all the lights to be green between your house and your destination. It just doesn't happen. There's going to be some red lights. There's going to be some broken lights. There's going to be lots of green lights, but they won't all be green. So interest rates may not be perfect. Everything in the market may not be perfect. It's still a good time to buy.